So I don't know if you've noticed, but there seems to be a proliferation of advice on how you should trade Betfair in-play on horse racing. And it also seems that nobody loses. It just seems a one-way street to immense profitability. However, there are radical differences between trading a pre-off market and trading in-play. That's especially pronounced when you're looking at horse racing. But it also explains why you get such a high strike rate when you're trading in a certain style on in-play horse racing. And if you want to learn all about that, then watch the rest of this video. I've been successfully betting and trading for over 20 years. So if you want more videos like this one, then please subscribe, like, and click on the bell icon to get notification of new videos as they're released. You should also visit the Academy, where we offer more structured learning. You can visit the forum, where you can speak to like-minded people and download additional content. And don't forget to go to our website and download a free trial of BetAngel, the cutting-edge software that will completely transform your trading. So as you're well aware, there are many different ways to actively trade, but fundamentally there's a line drawn down the middle of most sports in terms of the activity pre-event and then the activity while the event is actually in play. And different sports throw off completely different characteristics. If you look at cricket and tennis, there's not much activity before the off, and then there's tons in play. You know, you're looking at 95% or more of the money gets matched in play. But when you look at horse racing, you find about 20% of the money is matched in play and about 80% pre-off. So in play on horse racing only does about 1/5 of the amount of money that you get matched pre-off. And most of that is matched late on in the race when people are scrambling to either back or lay the winner or loser within that particular race. So there is an opportunity on in-play horse racing, but it's a very different opportunity from the one that you see on pre-off horse racing. And also the way that the market behaves is very different as well. If you look at pre-off horse racing, it's driven by emotion and opinion, whereas when you're looking at the in-play period, it's driven by exactly what's going on that course. And that is determined in a number of different ways, but also that, you know, there are certain key fundamental characteristics that determine the likelihood of you getting a successful trade. And it's worth explaining that in a little bit more depth. And we're also going to use a different sport. We're going to use football to explain exactly how you should interpret and look at the way that you trade in play. So to describe the sort of strike rate that you think you should get, I'm going to use a football match. And it's important to understand what your strike rate is at any individual sport, because that's how you will become profitable long term. People love to win, but in fact winning isn't profiting, and that sounds an odd thing because most people's experience of betting or trading is that they just want to win and they're focused totally on winning. But that's only one part of a 4-part equation. You need to have how often you win, how often you lose, how much you win, and how much you lose. I've done videos on it, I will link to them, and you can explore those videos in much greater depth. But fundamentally speaking, if you're just focusing on winning, you're only filling out 1/4 of the equation that will get you to long-term profitability. And I meet loads of people that win very frequently but never make any money. So what you're fundamentally looking for is an edge within a market. But the thing that you need to understand is how often is the trade that you're going to do likely to win, because you need to exceed that win rate in order to be profitable long term, in order to describe that you definitely do have an edge. And if we look at a football match, the best way to describe this is if we have a strategy that revolves around a goal being scored or not being scored, that can directly impact the sort of strike rate that we're likely to get. Because let's say, for example, and I'm using a rough judgment here, that a goal is scored in a football match at 30 minutes on average. If your strategy is to basically trade in and then basically trade out at 30 minutes, then you will be right in the center of the market. Your strike rate will be, the occurrence that you're looking for will occur 50% of the time. And that is because while the average goal is scored at 30 minutes, it could be scored earlier, it could be scored later, but over 1,000 matches or so on, you're going to be bang in the middle of that. So if you want to increase your strike rate, if you want to win more frequently, then basically you would put your trade in and out well under 30 minutes. If you put it at 15 minutes, your strike rate will start moving up. And if you trade in and out in the first 5 minutes, where the average time for a goal is 30 minutes, your strike rate is going to be enormous. It's going to be huge. You're going to win very, very frequently. But the problem is you still won't make money in the long term unless you've got a definable edge. If you're ahead of the market in some way or another, whether it's through execution, selecting the right match, adjusting your trades, or modifying your trade when you consider that it's likely to go wrong, then you won't profit over the long term. All that you've done is you've basically increased the rate at which you win, but when a loss comes in, that will basically wipe out a lot of those particular gains. And exactly the same thing can happen when you're trading in play on horse racing. So when you're trading pre-off horse racing, there's lots of clever things that you can do. If you look at the market in general and you back something 10 minutes out and then you trade out at post time, what you will find is sometimes you win, sometimes you lose, but overall you'll probably break even. And that is because you're not putting any thought process into the equation at all. You're not doing anything to influence the outcome of that trade. But if you plotted that scenario 1,000 times over, you would end up with what we call a normal distribution. And basically it's saying that sometimes you win a lot, sometimes you lose a lot, but it's more likely that you'll lose a bit or win a bit, but it will all average out over the course of time and you get a standard distribution. Now that's okay when you're trading pre-off horse racing, because you're not reliant upon any underlying characteristics, and there are many clever ways in which you can just nudge that in your favor, especially if you're going to select certain types of races, you're looking for certain types of setups, scenarios that are likely to repeat or occur, or characteristics within the market that you can exploit. My standard strike rate on horse racing, I'll win 70-80% of the time. If there's better quality racing and better liquidity, that number goes up, and if it's lower quality, that number goes down. But I basically adapt my style according to what I see within the market. But the interesting thing about the way that the market is set up is if we look at the ladder, we look at something that's priced at evens on course, which would be decimal odds of 2 on the exchange. That's the sort of midpoint within the market. Evens, decimal odds of 2 equal a 50% chance that that event is going to occur. That horse will win that particular race. So that's the actual midpoint within the market. You've got an equal chance of the horse winning or losing at that particular point. Now the funny thing about if you look at the way the odds are distributed on the ladder is that's not actually the middle of the market when you're looking at that distribution of ticks. Ticks are individual odd increments up or down on the ladder interface itself. The strange thing about that is if you actually look at odds of 2 in decimal odds on the ladder, you will find that there are 100 ticks below that particular point within the market, but there are 250 above it. So the interesting thing is, if you're looking for a relatively small gain within the market, it's harder for the market to pull that price in and fill your ticks on the downside than it is to actually fill them on the lay side, because basically 50% of the market is distributed across 250 ticks, but on the way in it's distributed across 100. So if you're actually looking to do a lay to back on racing, you will find that you tend to get a higher strike rate there than if you're doing a back to lay. You can do both of those, no problem with either of them, but one will have a very different strike rate according to the other method if you're going in the opposite direction. That's reflected in all the stats that you see and the way that the market trades, but there's also another key characteristic in terms of what strike rate you would expect if you're trading in play that we should also look a little bit deeper into. So the other thing that we should be looking for when we're looking to do a trade in play are the odds. It makes perfect sense really, because as we've discussed earlier, if you have something that's trading at evens at odds of 2 on the exchange, then we know that that has a 50-50 chance of winning. If you basically go in and lay something at odds of 50, or you back it for this particular purpose, you will win or lose 50% of the time. It doesn't matter what you do, it's a flip of the coin effectively. But when we're actively trading, you're obviously looking to get in on a position and looking to get out on another position. So for example, if we trade something at odds of 6, then should we back or lay that in trading terms? What would we do if we're trying to do a trade in play on that? Well, if you back at odds of 6, you've only got a sort of a 13% chance of that horse going on to win the race. So you know that the odds are stacked against you in terms of that trade actually playing out. But if you do a lay to back, particularly if you're trading in play, then you've got an 83% chance of winning that trade, because all we're doing is we're working out the implied probability. The market's relatively efficient, and therefore you know that the horse is just going to lose naturally that percentage anyway. So your strike rate will be incredibly high. You will win 80 odd % of the time, if you go in and lay a horse at odds of 6. So what happens if you actively trade that? If you don't just let it run to the end of the race, you actually trade out at some point above odds of 6. If you do a lay at 6 and then you back it at some higher odds on the ladder, or whatever interface you're choosing to use. Well, the interesting thing then is that your strike rate will multiply up massively. It's like the example that I gave you in the football. If the average goal is at 30 minutes and you're getting in and out of the market at 5 minutes, that's going to work really, really frequently. However, if you're doing it at 30 minutes, you're just going to match the underlying occurrence of a goal being scored effectively. So when you look at odds of 6 and you start looking at the ladder above 6, you've got all of those ticks all the way up to 1,000, which you could actively trade out at. And the shorter you make that offset in play, the more chance you're going to get of that trade being matched, just thanks to the variation within the market. And therefore your strike rate is going to go shooting up. So if you want to know why in-play trades win quite frequently, if you basically lay at slightly larger odds and you offset by a relatively small amount of ticks, then your strike rate will be incredibly high. But here's the kicker: you still won't make money, because when a loss comes in, it obviously is going to wipe out a significant number of those gains, because when you're having to lay at odds of 6, for example, your liability would be quite high, and therefore you'd need an extraordinary number of wins to be able to offset that loss when it comes in. So when you look at in-play trading, you have to take that into account. A lot of P&Ls, a lot of the sort of strategies that you see will naturally throw off win after win after win after win after win, but it doesn't necessarily mean that it's profitable. So when you do any type of trade in any market, in any trading style, it's really important to understand those metrics so that you can understand what you need to do in order to get profitable. So if you want to get profitable, you would have to follow things that I have sort of discussed a little bit before. But basically you're always looking for that edge. You know, successful betting and trading is all about getting an edge, getting a slightly better price, doing something that other people aren't doing, looking for opportunities, exploiting the bumps and ripples that you see within the market. And when you're looking at in-play trading, there are a number of ways that you can do that. And the funny thing is, you know, after you've watched this video, you'll be able to identify if people are doing this or whether they're just trading at random and taking advantage of that very high strike rate. Because the way that you would approach any market really is you're looking for the right type of market, you're looking for the right type of strategy, and you're probably, especially in play trading, looking for the right selection within that market. So if you're not doing any of those things, you pull yourself closer to the naturally generated random strike rate that you're likely to get through the generic strategy that you're deploying. If you deploy a generic strategy generically into a generic market on a generic selection, you're going to get generic results, and that will be break even long term minus the commission that you've paid. In other words, you're not really going to make any money. But if you choose the right market with the right selection, and especially in play the right course and the right selection, then that will enable you to just nudge all of those characteristics in your favor. I have done videos on pace before, so that you can understand how a race is likely to be run. That's a key element of understanding how you're likely to trade in play, as is how the race is going as the race is actually underway. I learnt to race read many years ago simply because I could hear the commentators saying things, got very interested in what they were looking at and what they were seeing, and then I gradually learnt to be able to race read. And the great thing about modern technology is when we've done things like integrate the data from total performance data, you now have lots of really good quality data right in front of you as to how the race is actually going. So even if you make the right selection in the right market at the right course, then you can tell fairly quickly if that is not playing out the way that you should expect, and that will allow you to limit your losses when a situation occurs. And you'll be able to do that quickly and faster than people who are actually trying to race read. You've got quantifiable data right in front of you. So it is perfectly possible to profit from in-play trading. There are a number of ways of doing it, but very often a lot of the things that I see are basically based around people doing just a high strike rate strategy. There's no particular skill that is being deployed there. And therefore, when you pursue any strategy in any market on any sport, it's really important to understand exactly what that natural strike rate is. If you can work out what that is, then your objective primarily over a period of time is to exceed that. That will allow you to get profitability over the longer term, regardless if your strike rate, you could have a low or a high strike rate, but as long as you've got an edge, then you will be long-term profitable. But understanding those key things is probably the most important thing that you can understand when you're doing any type of trading.